Vertical spreads are one of the most versatile and useful option strategies. They combine the exposure of standalone long or short calls or puts with the protection of predefined maximum losses and capital usage. Looking at this graph, we can see a stock price changing along the horizontal axis left to right, and the profit and loss of the strategies we'll be analyzing on the vertical axis up and down. We'll start by buying a call, represented by this symbol above the horizontal axis, while simultaneously selling a call with a higher strike price. Notice how the call we bought is larger than the call we sold, representing their difference in price. Also, remember that with vertical spreads, we're buying and selling both options of the same type, on the same underlying, for the same expiration, and in the same quantity. The only difference being their strike prices. In this case, we're buying the more expensive option, so this position will be initiated for a net debit. At expiration, if the stock price remains below both calls, we will lose the amount we paid to open it, represented by the yellow line. If the stock price expires between both legs, we'll have a profit or loss proportional to the exact stock price at expiration. And if it's higher than both calls, the strategy will reach its maximum profit. The break-even point at expiration will always be between the call we bought and the call we sold. Option traders sometimes get confused when looking at this graph and comparing it to the behavior they see in their own trades. This is because what we're looking at now is only a representation of profits and losses at expiration. Prior to expiration, the P&L line has a very different shape, and this is a more accurate representation of what happens as the stock price changes right now. In this example, we bought a call spread where both calls were out of the money. Depending on where the stock price is, this same option strategy could also be established at the money or in the money as well. This strategy, called a long call spread, is the same regardless of where the stock price is with respect to the calls we bought and sold. The only thing that would be different is the price of the call spread. We mentioned that at expiration, the dashed line will merge with the yellow line. This is because the difference between the P&L line right now and the P&L line at expiration is a reflection of the uncertainty related to time to expiration and the level of implied volatility in the options. As time passes or implied volatility decreases, the current P&L line will start approaching the expiration hockey stick final version of the P&L line. Because of this, in our current out-of-the-money long call spread example, if the stock price doesn't move, the current P&L line will start approaching the final expiration P&L line as time passes. In this case, time is working against us. We need the stock price to move in our direction before expiration, or we will lose our whole investment. If the stock price does move in our favor and we're fully in the money, the opposite will happen. Now, if the stock doesn't move at all until expiration, we'll reach max profit as time passes. Time is working in our favor in this case. The trade we just looked at was a bullish vertical debit spread called a long call spread. Now, we'll look at the bearish version of it, which is very similar to the one we looked at, but with puts. In this case, we will buy a put and simultaneously sell a lower strike put so that the whole trade is initiated for a debit. The profit and loss line is similar to the one we had for the long call spread, only this time we want the stock price to go down to profit from it. Likewise, if the stock price goes higher, we'll have losses represented by the dashed line, and at expiration, our P&L would be the one shown with the yellow expiration line. The trades we've looked at here are vertical debit spreads because they were initiated for a debit. Their maximum profit is reached if the stock price makes them in the money at expiration. As we saw, long call spreads are bullish strategies, whereas long put spreads are bearish. In addition to debit spreads, the second type of vertical spreads are credit spreads. As the name suggests, these strategies are initiated for a credit, and max profit is reached if they expire fully out of the money. In the case of a short call spread, we will sell a call while simultaneously buying a higher strike call. You can see in the relative size difference that the call we're selling is more expensive than the one we're buying, so the whole trade is initiated for a credit. In this case, if the stock price remains out of the money until expiration, we'll keep the max profit, which is the total amount of the credit we got when we opened the trade. The break-even for this trade at expiration will be in between both call strike prices, and max loss will occur if the stock price is fully in the money at expiration. In the case of an out-of-the-money short call spread, if the stock price doesn't move and time passes, or implied volatility decreases, the strategy will show profits until at expiration it reaches max profit if it is fully out of the money. Time works in our favor in this case. If we want to create a vertical credit spread with puts, we can sell a put while simultaneously buying a lower strike put. Since the put we're selling is more expensive than the one we're buying, the whole trade is initiated for a credit and has a similar P&L graph than the one for the short call spread, with the difference being that the short put spread is bullish and the short call spread is bearish. We can see the profits and losses for both strategies as the stock price goes down and also as it goes up. We can see here that vertical credit spreads are initiated for a credit and reach their maximum profit if they expire out of the money. Short call spreads are bearish strategies, while short put spreads are bullish. Here we have a summary of both debit and credit vertical spreads. You can see their directional outlook, maximum profit and maximum loss. Notice how in all cases the spread width limits both max losses and max profits, and is the reason why this strategy is considered a somewhat safe alternative to outright selling options and a cheaper alternative to outright buying them. Vertical debit spreads and credit spreads are strategies that are used by options traders all the time. One of the many reasons why traders use them is to be able to initiate positions in expensive underlyings, where it would be impossible to do so otherwise because of the required capital. As long as you have the capital defined by the width of the spread and the number of contracts that you want to trade, vertical spreads are a great way to gain exposure to option strategies, regardless of stock price. If you're a new trader and want to know more about options trading, sign up to my options trading course on Udemy, where you will learn everything you need to know about options and options trading. It doesn't matter how much you already know about options, you will learn fundamentals and techniques that will certainly take your options trading to the next level. Sign up now to take advantage of a special promotional price using the code included in the description below, and don't miss out on this opportunity to become the best options trader you can be.